Yeah, we'll start in exactly a minute. I think we'll get started. So, good morning, everyone. I hope I'm loud and clear and visible. So yes, so I welcome you all to our session, Books and Beyond. So before we begin with the session, let me start with a simple founder reality check. So if I told you 2026 starts tomorrow, would your books, VAT, and overall financial systems hold up, or would you quietly panic? So if it's a second one, relax. You're in the perfect session here, and we'll take care of it. So 2026 is coming at full speed, and the winners next year won't be the loudest founders, they'll be the most organized. So clean books, correct filings, and clear visibility are no longer optional. They are your competitive edge. So today is all about practical clarity, not theory, not textbook compliance. Everything we share directly comes from what we see every day inside UAE businesses, what works, what fails, and what founders must fix before 2026 hits. So we have two industry specialists on our panel today, Ramesh and Roshan. To start with the session, we'll have Ramesh. Ramesh is a specialist in transforming disorganized operations into high-performing systems. He has helped founders regain control, visibility, and confidence over their numbers. Today, he'll be guiding you through closing your books the right way, avoiding common year-end blind spots, planning hires and payroll efficiency for the coming year, and subtle strategies that keep top businesses consistently effective. So you can expect practical, actionable advice, the kind that separates good operations from great ones. Over to you, Ramesh.
Thank you, Mishan, for the brief introduction. Welcome, all of you. Hope you all are having a good day. Actually, before we are conducting this webinar, we were actually just thinking, and we got few messages that, I think we are going to have a long weekend from starting tomorrow next week. So if this closing of books will give a scary feeling that, the holiday will get screwed up or not. So nothing to, worry about it, but we just want to give you some feeling about how the closing can be much more smoother. Because what we had seen that we did some of the webinar and we used to deal with clients. And the last year also we had seen some of the pain points is that the topic is actually very simple. But the problem is that, many of them feel that, it can be done. There is a feeling of complacence. Like if you're driving in a highway road, there are no road bumps. Sometimes there are chances that you might get dozed off. That is a feeling sometimes when you are into the financial figures, when you approach everything is going on well, but sometimes it can trigger, some of the flows where you have to, get, you will touch the deadline, then only you have to pick it up. So that is why we are just thought we will present few of the main points towards the year-end closing process. So let me start with the first one. If you have any questions after any slides, you can raise your hands and then we can address it. Or We can address it after the session once the time permits. Feel free to express your things. Okay, so first subject is review ledger and confirm balances. So what we had seen in many of the cases from the clients at when we are scrutinizing the ledger, sometimes some of the transactions which has been booked, some are unidentifiable. Like sometimes the purchases has been booked, but the invoices are not there. This is why we normally say that you would have been received the stock, you would have been paid to the supplier, but the invoices is not booked. So this scrutiny has to be done properly because sometimes the proper follow-up has not done. Even the supplier had forget because the product or services which is delivered through a delivery note or through a quotation, it has been done and we paid it, but we forget to obtain the invoices. So these are the things which we need to actually verify, evaluate, and we need to scrutinize all the ledger whether it is properly accounted or not. And most important thing, towards closing of the year, we used to get statement of accounts from clients and vendors. This is an actually from the audit point of view also it is required because when the audit starts, when the statutory audit starts, normally they have a standard template where they send to your prime customers and vendors where they will ask for the balance confirmation about the company. So this practice actually we can start doing now itself. Not by sending the letters, you can actually get the statement of accounts because anyway, I think most of the organization, we recommend most of the organization should follow before you paying to your vendor or before collecting, you should exchange your statement of accounts, the transaction details, so that your balance and their balance will tally it. So this confirmation of balances, it is very mandate and it's very important to do it at the year-end closing. I'm moving on to the next slide. In case if you have any questions, you let me know by raising your hands. Okay, let's move. Next is staff loans and advances. We had one client last year, not one, one case which we really remember that there are advances, staff loan had been given, and it was actually hanging on to the books of accounts for a long time. When we scrutinized the ledger, we had seen that that payment had been made a long time, and then still that balance is there. And when we check the payroll, that we can cross verify the thing. So in the payroll, that staff name is not there. So when we check, given to the client for verification, they told that the staff had already left and he already settled this amount by cash. So these kind of flows can be identified and needs to be evaluated properly because sometimes staff would have been settled in a way where you would have been processed full and final settlement. You could have been reduced it and then you paid it back. You paid the balance amount. And the accounting, the proper recording has not been done properly in the books of accounts. So this needs to be evaluated and needs to be corrected. So if there are some staff loans or advances, like many times, I mean, I don't know how many organizations is having that practice of giving the advances, but sometimes residential relocation, expatriates, especially expatriates, they might be having some loans and advances related to visa, family matters, or everything. So this need to be taken care. And also auditors, if they see any staff advances or loans are there, they also request confirmations from the staff. This is very important that they normally get it signed from the staff that staff also admit that I owe this much amount to the company. So these practices can be done before year end. If you have any doubt, let me know. I'm moving on to the next slide. Next is the most important part, cash and bank reconciliation. We normally in finance, we normally say if your bank reconciliation is done on a daily basis, 95% of the finance and accounts work is over. So when you moving to the year end, you don't need to worry much because you're most of the, especially these days, the transactions, whether it is inward or outward, whether it's payment or receipts, you normally. So in that case, the bank reconciliation is very important, and especially most of them having multi-currency account. So it is very important to do the reconciliation on a daily basis that any unidentified transactions has been captured, has been addressed and recorded properly. We had one client last year not last year, even in the recent time, we had seen that when we are doing the bookkeeping of one of the client is that there were few debits in the bank statement, which is coming from the corporate card. And nobody was aware. They were actually thinking that, it is a bank charges and it is a continuous debit. Like in an alternate days or maybe in a 1 week gap, we had seen that, there were continuous debit and it was showing some of them are US. And when we asked the client, they told that no, they are not aware about it. So when we verified in detail, we had seen that that is coming from their credit card debt. Sorry, the debit card has been used in some purchases by some of the sales team, and that subscription is like auto debiting or something like that. That details. So these kind of things actually people are not aware because they are thinking that it is bank charges, even though it is $35, $40, or $100. It matters a lot when it is getting accumulated. So daily bank reconciliation actually it is suggestible. If that is not happen or considering the transaction, you can actually do it on month end. But bank reconciliation is important, and once that is done, majority of the accounting work is finished. And it is very important. Not only the bank statement is required, we need confirmations from bankers that this is the balance as on 31st of December or 31st of October. Some of the clients are normally taking even every quarter for that is due to start funding and everything. So 31st December, you can actually take a balance confirmation from the bank. That definitely auditors require. You don't need to wait for the audit to happen. That can be done at the time of closing itself. Okay. Next is inventory valuation. I hope you don't have any questions in between. In case if you want me to stop and answer anything, you let me know, please. Next is inventory valuation. Wherever the products are involved, you have to fix a day for physical stock taking. Normally, what is the practice happen is that whenever the physical stock taking is happening, we normally doesn't do the sales. Also, we don't book any purchases. Not book purchases. The purchases will not be done on that same day, so that all the records can be maintained properly, and then you can verify the stock based on the stock sheet from the system. And you can actually identify the moving and non-moving stock at this time, because there will be stock lying for a long time which have not been moved, and maybe it is closer to expiry. So you can actually think about that, how to dispose it in a low rate, a discounted rate. Or there are items which needs to be written off, that maybe the expiry date is over and then it is lying, or it is damaged, it cannot be resaleable. So this all things can be evaluated, and normally every month closing, if you can do, that would be better. But considering the volume of the items or transactions, normally we keep it on the year end. But this has to be done on a particular day, and on that day, completely all the transaction and operation should be shut off, and then you can do this. And valuation of inventory, that is also another aspect, because some organization will follow FIFO method, first in, first out. Some organization will follow LIFO method, last in, first out. Some organization will do as per the market valuation, because if your product carries market value on 31st of December, they will take that market rate and then they will do the valuation, because that affects your profitability in your financial statements. So these all things you need to consult with your CFO, or you have to consult with your auditors, and then you have to ensure that this policy has been consistently followed from the previous year and the ongoing year. Okay, so inventory valuation, that is finished. Next is complete year-end adjustments. These are actually normally depreciation, accruals, and provisions. Many of you know this, but sometimes we had seen last year that if you want to know the actual profitability of the organization, we need to actually see the utilities, visa cost, insurance, because normally what happens is that November and December, sometimes insurance renewal comes, expatriate visa cost will come. So in all those cases, what is happening is that the December electricity or telephone bill or any utility like cooling period, in UAE we have cooling period, cooling charges. All those things can be the December one, it will come and hit on January. So if you don't know the exact cost, what we normally recommend is that take the previous charges and then you keep it as a provision, so that the expense is booked. So your profitability, whatever it is reflecting on at the year end, that will show some genuineness. And once the real amount comes, you can actually do a reversal transaction on the next year. So these things, if you are taken care, at least when you are forecasting for the next year, the figures will be much more feel actuals. Then prepayments, what I'm saying is about insurance and visa cost. We have one client, actually some of the expatriate visa cost which was being paid in December. See, this is actually an aspect which actually increase the profitability. So some of you might have some questions that, if you put the expenses on only a portion of the expenses, then it will increase the profitability. But that is the purpose, because you cannot book a expense the whole into 1 month. Like visa cost normally of an expatriate, what we pay is that for 2 years. So suppose you paid 3,500 dirhams for one expatriate cost. That one you cannot charge completely in December. You should put it in prepayment, and then the allocation of that expenses for the particular month, you have to allocate it. That is the way we need to do it, because many times we had seen that some of the accounts gone through like that, and then auditors had been questioned. So this aspect, if you can see, your year-end closing process will be much more smoother, and it will reflect actuals. Update fixed asset register and depreciation rates has to be fixed, because as per the IFRS rules and as per the auditor's statement, you can actually charge that depreciation. We normally follow every month when we are preparing MIS reports, management information system reports, we normally follow that rate which had been given by the auditors or as per the accounting standards, so that year end there are no confusions or adjustments, there are no difference entries to be passed. So fix that rates, that can be, finance manager or CFOs can be assist you on that. So make sure that rates are fixed and you allocated that expenses properly. I'm moving on to the next slide. Organize company documents. This is actually primarily this is the one we have to keep it ready, because licenses, trade licenses, legal documents, memorandum of association, articles of association, then shareholder or partners IDs and their agreements or contracts, tenancy contracts, staff employment records, employment contracts, all these things. Actually, when the cost is involved, this has to be there in finance also, because sometimes when we ask some of the documents from the client, even from the audit point of view, when we ask, the employee records has to go to HR department, and then some of the legal documents has to go to legal department. What we normally recommend to the finance team or to the founders is that, it should be accessible to in one place, because all the company documents and the staff records and everything, it is required, and auditors also will check randomly, or they can ask all the documents. So make sure that all these documents, when you are coming to year end, it is accessible in one place rather than, going around to different departments and delaying the whole process. So this is one factor which you can organize now itself. You don't need to wait for the year end. Any questions? Are you all here? Do you want to do any thumbs up or thumbs down or? Okay. Next is review receivables and payables. This is related to, again, customers and our vendors. We need to analyze the aging reports, because there is a credit line which we give to the customers, and also there is a credit line for which had been received from our suppliers. So you have to ensure the whatever the amounts which had gone beyond the credit lines, whether they are under dispute, in like if you are payable, is there any dispute is involved, whether it has to be addressed before year end, or is it requires a legal action. And same way, is there anything which will go as a bad debt? That also has to be analyzed, because sometimes you just we just put it as the amount, and then we don't know whether this will receive it or not. But that allocation can be done, because when you analyze the aging report more than 90 days, more than 120 days, or maybe we will have post-dated checks with in hand, it could have been bounced. The people are not responding whether we have to deposit or not, because all these cases we had seen when we are checking with the client, they told that no, we already received the check. There is a post-dated check is there, so it is not a bad debt. But when we are depositing the check, it could have been bounced. So you need to ensure. That is why that in the previous slide, which I said, the statement of account is very important, because that is also a legal document. That is going to be a legal validity that, the vendor or customer is saying that, okay, this is the amount matching with your books. So this is very important that aging analysis has been done. analyze the bad debts and analyze the like payable, whatever you are paying payable to the creditors, that also is correct. Then VAT compliance check, very important. Again, whatever the VAT, like suppose if organization is registered VAT, you would have been filed quarterly all the returns. So all the returns which has been submitted to the FTA, the sales figure which you mentioned in that return thing, you have to ensure that you just take the sales report from January till December or January till November, whenever you are doing this, and then you ensure that it is matching with that sales which is already submitted to the FTA quarterly basis. Quarterly, you would have been filed it, because sometimes some adjustments would have been made after filing the return, whether that has been accounted in the next return. This has to be analyzed, because many times when we were tallying it, we had seen that sometimes the revenue is more, but what is reported into the FTA, that is very less. Then when we asked, they told that no, there were 2 invoices which we forget to raise it, but we will pay the VAT on the next return. And that is not the way we have to do it, because that looks little manipulative. So always ensure that whatever you submitted to the FTA, that is matching with your accounting records. And any credit note, sometimes like I submitted a VAT return on 31st of October. Maybe credit note would have been come on 10th of November. So in the next return, whether that has been accounted or that will be accounted, that track we need to keep it. So ensure that we can explain to auditors or FTA that this is how we had been done. Now, after all this, you prepare financial statements. You don't need to prepare, the system will generate. Now you can review the final P&L and balance sheet, the trial balance, profit and loss, and the balance sheet. Check for any ledgers. Again, here another ledger scrutiny is required, because when we gone through some of the statements, even the last corporate tax filing and the last year, we had seen some of the accounts is like miscellaneous expenses. Then we had seen general expenses account. Then we had seen suspense account. And there are a lot of transactions, and it is actually high volume transaction. It's a higher amount. So when we asked for suspense, they told that no, there is an unidentifiable amount in bank. We don't know who paid it. So that is why we kept it in the suspense. No, we cannot keep suspense account in the final accounts, even though you have explanation. And some people, because we had one case, one of the client had made an unofficial payment to get things done with some commission or brokerage or something, which is not really legal, and that they parked it into general expense account. It's a huge amount. So this all things will go for scrutiny. When it is hitting the bank, you should ensure that it goes into proper categorization. It requires proper approval and supporting. We cannot just put it in some suspense or general expense account and finalize it. So this is very important. After doing all the adjustment entries, after doing all this analysis and evaluation, when you see the financial statements, go through the trial balance one by one and see the ledger accounts, and ensure that everything you have explanation, you have supporting that why that transaction belongs to that category. I remember recently when we were filing for the corporate tax, there was an incident that founder had paid school fees for their children, and then it was actually accounted in as an expense or as a business expense. So normally, I mean, even though it is a founder and it is his business, it is his money. You cannot just expense it out into the in the organization. You actually you could have been do it in his current account as a drawing, or there should be an agreement, separate agreement, saying in the company that whatever the expenses, personal expenses, can be done from the organization level itself. So all these categorizations attached to be evaluated, analyzed, discussed, and ensure that it is clean records. So yeah, these are the things which you have to ensure. You need to when you are approaching the year-end closing. If you have any questions, you can put it in the chat. We will address you after this, or in case if there is any time constraint, we can email you. We will address your queries. Yeah, thank you.
Perfect. Thank you, Ramesh. That was sharp and very practical, actually. So now that we've covered the operational side, let's shift into the area that creates the most confusion and the For this, we have Roshan, a senior consultant at MS, someone with deep hands-on experience working with BIFC and ADGM environments. He's a compliance from the inside, understands the regulated ecosystem of and how it operates, and knows exactly what UAE businesses must prepare in terms of VAT, corporate tax, and all 2026 reporting expectations. So if you wonder what regulators actually expect, Roshan is the person you want to listen to. Roshan, over to you. Roshan, I think you're on mute.
Yeah, am I audible?
Yes, perfect.
Thank you so much, Mirshan, for the brief introduction. Good morning, everyone. I hope my screen is visible. And thank you, Kitaab, for the invitation. And thank you, Mirshan and Ramesh, for your insightful presentations. I'm genuinely excited to talk about something I strongly believe in, which is tax awareness to founders. I'll keep this section practical, simple, and free from heavy technical terms. We'll focus on what really matters and what can save you from unexpected surprises later on. So I will move on to the agenda, which we will cover. So it is the flow for the next few minutes. I'll start with a very fast VAT refresher, key areas that need extra care, and common mistakes founders usually overlook. Then I'll give you a quick snapshot of our first proper corporate tax filing season and what the FTA has been actively working on since. Finally, we'll dive into the hot topic in the UAE market, which is the UAE corporate tax. So I will move on to the VAT refresher. So VAT has been around for years now. So most founders have a general understanding of how it works, but let's revisit the essentials. So the first question is, when does a company need to register for VAT? So there is a mandatory registration threshold. So if your taxable supplies, which is your sales, exceed 375,000, you have to do your mandatory registration. And FT also allows voluntary registration if your taxable expense exceed 81,87,500. Now, here is a part that catches many founders off guard, and I have seen these scenarios in many recent times. So many of the UAE founders have a connected entity outside the UAE. And when a UAE company exports service to its parent or related companies, those services are zero rated, which is basically not VAT effect. But if that revenue exceed 375,000, VAT registration is still mandatory. So many founders ends up with late registration penalties because they assume zero rated is equal to no registration. And they even ask, it's not affecting VAT, then why we have to register? It's simply because that's what's written in the rule books. The other reminders, the key areas which we need to understand. Once you are VAT registered, you have to file your VAT returns quarterly. And you have to share your TRN certificates with all your suppliers. Only invoices with your TRN plus other valid requirements are claimable for you while filing your returns. Another aspect is, if you stop making taxable supplies for past 12 months or you are closed your business, you must deregister your VAT within 20 business days to avoid penalties. So I have seen many founders who misses out this. They've just closed the company and they just leave. So that's what we have to do when you close your business. Other common oversight which I have seen over a couple of years is not updating the FTA portal. So any change in ownership of your business, trade license, address, authorized signatories, or even validity of EID or passport of the controlling persons must be updated within 30 days of the occurrence. If that's not the case, then you will again attract the penalties. So that's the quick VAT refresh. These small steps can avoid major surprises in the future. So then I'll go to the corporate tax overview. So now we can just look to the corporate tax activity so far. The first proper filing season is in September 2025. Most of the UAE companies had their first filing in September 2025. And we have over 640,000 corporate tax filings. And the FTA has already initiated audits for a significant number of companies. What it means? This clearly indicates the seriousness and readiness of the authority. Faster responses, portal upgrades, and substantial hiring to enhance compliance monitoring. Now, coming to the corporate tax filing, we basically have two reliefs apart from the standard filing. If your company can't qualify for that two reliefs, then you have to do the standard rated filing. Now, what is the standard rated filing? Again, the registration part, if you incorporated your company, you have to register for corporate tax within 3 months of your incorporation date, and you will due for your first filing from 9 months of your financial period end. So standard corporate tax filing. So the corporate tax is 9% on taxable profits above 375,000. However, taxable profit is not exactly the same as accounting profit. Certain expenses are non-deductible, and the quality of your chart of accounts becomes key here. For example, as Ramesh mentioned earlier, one of his clients made an unauthorized payment, or other terms bribe, which can't be deductible while calculating the taxable profit. And entertainment expense, we can only detect 50% of that in a year. So instead of going through all the transactions in the year end, a well-structured chart of accounts saves you from messy year-end sortings. And I think this is where Kitaab and people like Ramesh can help the companies set up with a structured COA in the beginning of the year, or when starting preparing your financial statements. And another few requirements you have to follow while doing the standard corporate tax filing, which is the mandatory audit thing. So if your revenue exceeds 50 million, audited financial statements becomes mandatory. So if your forecast in the beginning of the year that you will cross this threshold, it's better you engage an auditor in first hand. The next crucial point for founders, if you are a sole founder and you are the main revenue generator in your company, you cannot simply withdraw salary or any other payments as you wish. Any payments to connected persons, be it salary, bonus, any other allowance, must be benchmarked, documented, and in arm's length. The same applies to all related party transactions. Any connected party transaction should be, again, will go through this benchmarking process. Next, I'll dive into the most popular reliefs in the first CT filing season, which is small business relief, aka SBR. This is, so it's very simple. If your revenue is below 83 million, you can opt for SBR and be taxed at 0%. This simplifies everything. No transfer pricing, no documentation, or no audited financials required for CT filing. However, choosing SBR means you cannot carry forward your tax losses. Now that's the case. So if I give you an example, if you made losses in your year 1 and year 2, which is totaling 500K, and in year 3 you made profit and you have a tax payable of 100K, you would normally offset up to 75% of that using your past losses. But if you selected SBR earlier, those losses are gone. So for growth-focused founders, it's important to assess before choosing SBR. So that's the catch in SBR. And we had a lot of discussion during September for companies which are currently in loss, but they are having a bright future. And instead of like going with the SBR and going with the SBR, we preferred them standard rated filing. Even though it's including a lot of document, we encourage them to go for the standard rated filing. So the next relief is qualifying free zone person, which is QFZP is actually the most celebrated relief, but also the most compliance heavy, which means many believe if you set up your company in free zone, you don't have to pay tax. But that's not the case here. To qualify as a QFZP, you must meet specific conditions. So in QFZP, if you want to opt for QFZP, you have to audit your financial statements. You have to properly document your transfer pricing. You must carry out qualifying activities. There is a list of qualifying activities, and you have to carry out the qualifying activities and avoid excluded activities. And there is a de minimis criteria that basically means your non-qualifying income must not exceed 5% of your revenue or 85 million. So if you breach any of these conditions in QFZP, then you lose your QFZP status and all your income becomes taxable at 9%. So that wraps up the corporate tax filing regimes and the standard corporate tax filing. And choosing of these filings and regimes is purely needs to be aligned with your business strategy and how you're forecasting your businesses. So here, I'd like to highlight this. A good tax strategy is a form of respect a founders show to their company, not just a compliance tax tick. So it should be a strategic, intentional, and essential for a sustainable growth of that organization. I think that's the end. Thank you all for your time. I hope everything is clear, and happy to take questions at the end if time allows. Thank you. Thank you. Over to you, Mirshan.
Thank you, Roshan. That was very clear and practical breakdown. I'm sure that helped everyone understand the process much better. And now, before we close, let's take a few questions. So we'll open the floor for a quick Q&A. You can drop the questions in chat. I see there are a few questions. I think we can take a couple of them. Yes, Ramesh, Roshan, I think both of you have one question. To Ramesh, can you please explain rates to be followed for valuation of inventory and forex revaluation? This is from Alexis. Ramesh?
Yeah, you can hear me?
Yes, clear.
Yeah. Okay, so the rates to be followed for valuation, if it inventory and forex revaluation. Inventory valuation, that is what actually I was explaining. You have to see the organization policy which has been followed for the last year. Either you take it like the last purchase cost, or if there are products which is actually fluctuating as per the market, then you need to take care of if it like commodities, they will have fluctuation rates. So you need to take, whenever you are doing the valuation on the 31st of December, you just analyze what is the value market rate of that product on that date, and then you need to do the valuation. Forex also, normally in UAE, we follow Central Bank of UAE rates. XC.com, some people are following it. But be consistent in what you are following, because auditors will have their own perception that how to apply it. Now, Central Bank of UAE rates would be much more better because that is widely acceptable. Yeah, so that, I think that answers that question.
Perfect. I think that's clear, Mr. Alexis. And there's another question from Mr. Yahia. This is to Roshan. Thank you for your insightful session. It would be my pleasure if you could make it clear that if my business makes loss this year, do I still need to file corporate tax?
Yes, thank you, Yahya, for the question. To answer that, yes, filing is mandatory even if you make a loss. Losses don't remove the requirement to submit the return every year. The benefit is that you can carry forward the loss up to 75% to offset your future profit. If you're planning to make profits in year 1 or 2 or 3, that's it. and if you're choosing the standard rated, and unless choose SBR, where loss carry forward is not allowed.
Right. I think that is clear then. I think we'll take one last question. This is from Zara George. Is it necessary to send the balance confirmation letters now? Usually auditors does this with their standard template. So I think one of you can take this.
Yeah, I will answer that. I was actually explaining this. Balance confirmation letters, yes, there is a standard template from the auditors, and normally they follow is that they take the email address of your vendors or customers, and then they will send it out. But what I was mentioning is that statement of account you can obtain. Like if you have vendors, you can just obtain the statement of account, and then clients also, you can send your statement of account and then get it a written email confirmation. So that would help. And then whenever the confirmation is happening, whenever the confirmation is requested by the auditors, you can actually send this as a supporting. Okay.
Perfect.
Yeah.
Perfect. Thank you. Thank you, Ramesh and Roshan. I think we've taken 3 questions for now. So if you have more questions, you can drop it in the chat or email us at, I will just drop the email ID also in the chat. So yes, you can email us at hello@kitaab.ai, or you can drop it in the chat and we will make sure that we respond to it personally after the session. So, thank you everyone for joining us today. And a special thanks to Ramesh and Roshan for sharing such practical founder-ready insights. And as founders, confidence comes from clarity. Clarity in your books, clarity in your processes, and clarity in how you plan for the year ahead. So that's exactly why we built a Kitaab. It's not just a tool, it's a partner for founders who want to stay organized, compliant, and in control of their business numbers. So without adding a complexity to it. So this is how Kitaab works. It's not a sales pitch. Just a reminder that you don't have to manage all of this alone. So we are here to help for that as well. So, so to actually help you to take this to the next level, we are also providing a free consultation for all attendees, a chance to get personalized guidance on your books, your taxes, and your operational process. So you'll also be able to get in touch with Ramesh and Roshan directly. I think they'll also drop their LinkedIn credential, LinkedIn socials here. And yes. And one more thing I would like to add is that since because we appreciate the time you've invested in your business today, we have a small surprise for you. You all can check your inbox after this session. You'll find a special gift from us, a little thank you for being here and for taking steps to strengthen your business for 2026. So we hope you leave the session inspired, informed, ready to step into 2026 with confidence, clarity, and control. So if there is anything you need to get done to run your 2026 smoothly, you can always get in touch with the team Kitaab. And we've just dropped a short review form. I think, Roshan, if you could go to the next page, you will find a short review form. And I think you can also drop the same in the chat. Your feedback means a lot to us. So we'd really appreciate if you could take a minute to complete it. And yes, thank you so much. I think we still have a minute or two. If you guys want to ask anything or drop the questions, it'd be great. I think we have one more question in the chat, right? 1 second, I'm not able to open it. Yes. It's from Kyra. Is it mandatory audit our financial statements if our revenue is below 50 million? Yes, I think. Roshan?
Yeah, I can take that question. It's actually a yes and a no question. So it's a no for standard corporate tax filing. If your revenue is below 50 million, audit is not legally required. And yes, if you want to be a qualifying free zone person, then audited financial statements are mandatory regardless of the size of your revenue. Yeah.
Perfect. Thank you. So I think then we'll wind up. It was great hosting you all, and we will be coming back with more such webinars, more interesting topics, and more interesting facts. Thank you all.
Thank you, Mission. Thank you, Roshan.
Thank you all. Have a
Thank you
great
all.
Thank you.
day, great week.
Thank you.